Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Once again, I want us to study about the format of the final accounts of a sole trader. Format of the final account of a sole what? Trader. Format of the final accounts of a sole trader. And once again, if we've been a blessing to you, if we've been doing something that is of great help to you, I want to kindly ask you to like, share, subscribe, and hit the notification bell. Ensure that that's where we will ensure that we will be able to notify you every time we receive a new video. Every time we receive a new what? Every time we receive a new video. So I want us to get the format of the final accounts of a sole trader. What is a sole trader? A sole trader is also a sole proprietorship. It's a sole proprietorship where the owner of the business is only one. The owner of the business is only one. And therefore, I quickly want to take you through the format of the final accounts. And we know that the final accounts are usually principally two. The final accounts are principally two. Number one, we have the income statement. Some of us will call it statement of comprehensive income. Others call it statement of profit and loss account. Different names for the same thing. Then we have the statement of financial position. Some people will call it balance sheet. Others will call it statement of financial position. So let's go to the income statement. Let's go to the income what? Income statement. And assume the firm is called XYZ income statement for the year ended December 31st, 2025. Now, I want to repeat what I've told my students in financial accounting over and over again. This is one of the easiest areas to pass. Financial accounting, financial reporting, advanced financial reporting. These are one of the easiest areas to pass. Simply because they are exams which examine you based on a format. And if you remember the format, you must memorize. You must understand the format. You must memorize the format if you want to pass the exam. And don't just memorize for the sake of it. You must start by understanding. Understand why we are doing what we are doing. Once you understand and memorize, then do what? Memorize. Now we start by saying sales. You start by saying what? Sales. We get the total sale and we capture it there and we say less return inwards. Less return what? The return inwards are also called sales return. They are also called sales return. This gives us net sales. This gives us net what? Sales. Return inwards, some people call it sales returns. We get our net sales. Once we get our net sales, this is the value of the goods. This is the sale we made. All the sales. we get all our sales. Now, we compare our sales and the cost of the goods we sold to get gross profit. To get gross what? Profit. I like saying, reason with your mind. Don't memorize. We say less cost of goods sold. 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 Now, we don't memorize. Ask yourself, we were doing business. How much did the goods we sold cost? At the beginning of the period, we had the cost of opening stock. We had the cost of opening what? Opening stock. So this is shillings in thousands. The cost of opening stock was this amount. But after the stock we had, the opening stock is the stock we had at the beginning of the year. The stock we had at the beginning of the year. We never bought it this year. It was bought last year, but there was a leftover. That leftover becomes our opening stock. Now, after opening stock was depleted, or just before it is depleted, we bought other stocks. We bought other what? So we say add purchases. We add what?
Purchases.
We add purchases. We add. Now, the goods we purchased, we transported them into the farm. We transported them into the what? What the cost of transporting them into the farm is called carriage inwards. It's called carriage. So we say add carriage inwards. Add carriage what? Add carriage inwards. Carriage inwards is the cost of transporting inventory from where we bought them into the farm. You must never forget this. There are two costs that we incur. One of them is called carriage inwards. As we carry inventory into the farm, it is called carriage what? Inwards. And it is part of the cost of goods sold. It's part of the cost of goods what? But now after we are in the business and some customers bought inventory and we are now taking them, the inventory to their house, to their businesses or to their houses, that one now is called carriage outwards. It's called carriage what? Carriage outwards is an expense. It's a business operating expense, and therefore it is recorded as expenses. But carriage inwards is part of the cost of goods sold. It's part of the cost of goods what? Remember, we are looking for the cost of, we are computing the cost of goods sold. But some of the inventory that we had bought, we returned. So we have returned outwards. We have returned what? So because we had recorded that we had received them as purchases, now we record we have returned them. So we say let's return outwards. Let's return what? Let's return outwards. Now, once you let's return outwards, you bracket it to reduce, you get the a figure we are calling cost of goods available for sale. Cost of goods available for what?
Sale.
Available for sale. Now, those are the goods that were available for sale. But we know, just like we had opening stock at the close of the year, at the beginning of the year, meaning that we never sold everything last year, even this year, we have closing stock. We have closing what? So we say less closing stock. Less closing stock. And our closing stock becomes opening stock next year. Less closing stock. The goods available for sale, less the goods we never sold, we get the cost of goods sold. We get the cost of goods sold. Now, please see where I'm putting my cost of goods sold. I'm putting it below sales. I'm putting it below what?
Sales.
And we are calling it cost of goods sold. We are calling it cost of goods sold. We are calling it cost of goods sold. Now, once you get our sales, you subtract cost of goods sold, we get something we call gross profit. We get something we call what? Gross profit. In other words, we're saying we bought as a sale, we sold goods and we made sales amounting to this, but how much did we buy the inventory at? We bought the inventory at this. So before deducting any other expense, the profit we are making is this. And we are calling it gross profit. Why do we call it gross profit? We call it gross profit because it is profit before deducting operating expenses. It is profit before deducting what? Operating expenses. Now, once you get it that way, we usually say this business may be having other investments that are generating it income. or maybe having other things that are causing you to have incomes. And therefore we say, add other incomes. Add other what?
Income.
Add other incomes. And we have said one of the incomes is discount received. Is discount received. I have done a video on discount accounting, and you can see, that's what I was saying, this is where we bring it. This is where we bring it. We can also talk about things we are going to discuss later called gain on disposal of non-current assets. Gain on disposal of non-current assets. We could also talk about interest income. We could also talk about interest income. We could also talk about interest what?
Income.
Maybe we have bought some bonds, some debentures. We have given loans of our excess money to somebody, and that person will give us the principal plus interest. So at the end of the month, the period, we are given interest income, or even dividend income, or even dividend what?
Income.
We invested in one of the blue chip companies, and at the end of the period, we've been given dividends. We have been given what? Dividends. So you add everything, you add the gross profit, and you add all the other incomes, you get what we call aggregate income. We get aggregate what?
Income.
Income. We get aggregate income. And from there, we say less operating expenses. Less what?
Operating.
Less operating expenses. Less operating expenses. And we know what are operating expenses. They could be salaries. They could be rent. They could be something we call depreciation expense. They could be carriage outwards. They could be loss on disposal. Of assets. They could be stationary. They could be petrol and fares. They could be repair and maintenance. What are expenses? What are expenses? They are resources which are consumed by the firm in the course of business operation. They are resources which are consumed by the firm. They are used up in the firm. Please mark that word. There's a very big difference between purchases or acquisitions and expenses. When we buy a motor vehicle, it is not an expense in accounting. When we buy a motor vehicle, it is not an expense in accounting, because an expense in accounting is what has been spent in the farm. So the only aspect of that motor vehicle that we record as an expense is the depreciation, is the loss, the value of the loss in the value for that asset. At the end of the year, we record the motor vehicle as an asset. We will not record it as an expense. Although we spent money, the money we spent is not expensed until we have used up the motor vehicle. Until we have used up the what? The motor vehicle. Many students, you find them taking you a non-current asset here, land, building, plant, machinery as expenses. They are not expenses because they are still there. They are not consumed. Expenses is what has been spent in the farm. It's what you had, but now you cannot get it. But we have land. We have motor vehicle, we have manufacturing plants, we have the furniture fixtures and fittings. So they are not expenses. They are not expenses. Expenses is what has been used up in the farm. So you get the total expenses and you add your total expenses, and we are saying the total income minus total expenses, we get profit for the year. We get what?
Profit of the year.
Profit for the year. We get profit for the year. We get profit for the
year.
We get profit for the year. Now, our profit for the year is what is taken to the balance sheet. Is what is taken to the balance sheet. In the balance sheet, we say capital add a profit for the year, less drawings, we get a closing capital. We get a closing what?
Capital.
Opening capital. You add profit for the year, you less drawings, you get closing capital. You get closing what?
Capital.
So let's look at the balance sheet. That's the format of the income statement. That's the format of the income statement. Let us quickly look at the balance sheet or the statement of the financial position. Let's look at the balance sheet or the statement of financial position. Of the financial what? Position. Again, we call it XYZ. The firm is called XYZ or XYZ. And we say the statement of financial position as it. Something very important there. We talk about that the incomes is a specific date, but we also talk about the balance sheet as at. So the income statement, we say the income statement for the year. We say the income statement for the what? But the balance sheet is not, we don't say for the year, we say as it. The income statement, we say it is for the whole year. We are doing it for the whole what? But the balance sheet, we say as it because it is at one point in time. At one point in time, we say it is the statement of financial position as it. So let's quickly record the statement of financial position. So we say XYZ statement of financial position. Statement of financial what?
Position.
Statement of financial position, and we say as at 31st of December 2025. So we start with non-current assets. We say assets. The format is very important. You need to memorize the format. But before memorizing, you understand. You do what? Understand. So we say assets, then we say non-current assets. There are two categories of assets. We say non-current assets. We say non-current assets. We say non-current what? Assets. We say non-current assets. And the first one is land and building. Is land and building. Land and building. Land and building. Land and building. Then we talk about plant and machinery. Plant and what? Machinery. Plant and machinery. Then we talk about plant and machinery. We talk about motor vehicles. Then we talk about furniture, fixtures, and fittings. Furnitures and what? Fittings. But what is furniture, fixtures, and what are fixtures and fittings? They are the things that you have fitted in the house. Maybe you are partitioning the house. Maybe you have shelves in the house. Anything that is furniture in the house, it is part of the furniture, fixtures, and fittings. And therefore, we say total non-current assets. Total non-current what? Now, very, very important that assets are arranged in order of permanence. Assets are arranged in order of permanence. The most permanent is land and building, followed by plant and machinery, followed by motor vehicles, followed by fixed furniture, fixtures, and fittings, and then we talk about so we get the total non-current assets here. We come to current what? Current assets. Current assets. So non-current assets are assets which will take more than 1 year in the farm. Current assets are the assets which take less than 1 year in the farm. And we start with inventory. We start with what? With inventory. Then we talk about trade debtors. We talk about trade what? Debtors. Please mark how we account for trade debtors. We say less discount allowed. Less discount what? Allowed. We get net debtors. We get net debtors. We get net trade Debtors. Then we say sundry debtors. Sundry what?
Debtors.
Sundry debtors. Those are debtors, people who owe us money, but not from, because we sold them on inventory on credit. We sold them other things other than inventory, and they have not paid us. Then we talk about prepayments. Talk about what? Prepayments. These are amounts we have paid, but we have not used up. We have not used up. Then we talk about, by the way, we talk about investments. We talk about investments. And I want to make it very clear that we can have non-current investments and current investments. We can have non-current investments and current investments. Now, non-current investments are things like when you buy shares in a company and you do not want to dispose those shares within the next 1 year. They are non-current investments. Current investments are things like treasury bills. They are investments that you have done and you expect to liquidate them within a span of less than 1 year. They are called investments. They are called what?
Investments.
Then we talk about bank. And then we talk about what? Cash. So you add all of them, you get total current. Total current what? Assets. Total current assets. Total current what? Assets. Now, total non-current assets plus total current assets, we get total assets. You get total what? Please mark it. Once you get it there, you double underline. You double what?
Underline.
Below there, you say financed by. You say what? Financed by. And you're saying we are financed by capital and liabilities. Capital and what? So what are we saying? We are saying, where did we get the money to get all these assets? Where did we get the money to get all these assets? We got the money from capital. Yes, we got the money from the capital, and some of the money came from profits. Some of the money came from the what?
Profit.
And then we less drawings. We less what?
Drawings.
We less drawings. We get closing capital. We get closing what?
Capital.
We get closing capital. We get closing capital. We get closing capital. And then we come and we say non-current liabilities. Non-current what?
Liabilities.
Liabilities. These are long-term liabilities. These are liabilities which you expect to be paid with a period of more than 1 year. And we could include things like debentures, things we call debentures. Yes. Debentures, they could include loans. They could include what?
Loans.
So the total of them, we say total. Please look at what I'm doing at the bottom here. The first letter is in capital, the others are small letters. Total non-current liabilities. Total non-current what?
Liabilities.
Total non-current liabilities. Then we talk about current. Current what?
Liabilities.
Current liabilities. Current liabilities. Current liabilities, please mark, they include bank overdraft. They include trade payables or trade creditors. And then we say sundry or other creditors. Or other what?
Creditors.
Other creditors. So we say total current liabilities. Total current liabilities. Now then you add the capital, the non-current liabilities, current liabilities, you get total capital and what? And liabilities. Total capital and
Liabilities.
that's the format. That's the format for a sole trader statement of financial position. The assets are arranged in order of permanence. The assets are arranged in order of what? The inventory are made. Permanence means the most long-lasting first, the least long-lasting later. Inventory is arranged in order of liquidity, the ability to turn into cash. The ability to turn into cash. The most illiquid inventory, current assets are arranged in order of liquidity, and the most illiquid current asset is inventory, and the most illiquid is cash. The money you have in the office, the money we have in the office. Current liabilities are arranged in order of the urgency to pay. And it is assumed that bank overdraft is the most urgent because the moment the money hits into the bank will take its money. That's the format of preparation of the statement of financial position for a sole trader. Once again, I want to urge you, ensure that you subscribe, you share, you like, and you hit the notification bell so that every time we load this kind of videos, we will be able to inform you. Thank you very much.